What are Section 1231 assets, and how do they affect gains/losses? Have you ever wondered how certain assets can impact your financial statements when sold? Let's talk about Section 1231 assets and their role in gains and losses. Section 1231 assets are a specific type of property defined under the United States Internal Revenue Code. This category includes real or depreciable business property that has been held for more than 1 year. Common examples of Section 1231 assets are buildings, machinery, land, timber, livestock, and some intangible assets used in a trade or business. However, it is essential to note that property held primarily for sale to customers or certain types of inventory do not qualify as Section 1231 assets. To be classified as such, the property must be used in a trade or business and held for over 1 year. Now, let's discuss how these assets affect gains and losses when they are sold. When a Section 1231 asset is sold, the resulting gain or loss is treated under special tax rules. This unique treatment combines the benefits of capital gains with the advantages of ordinary loss deductions. Gains from the sale of Section 1231 assets are generally taxed as long-term capital gains. This is beneficial because long-term capital gains are taxed at lower rates than ordinary income. On the flip side, losses from the sale of Section 1231 assets are treated as ordinary losses. This means these losses can fully offset ordinary income, providing a more immediate tax deduction compared to capital losses, which have limits on how much can be deducted. This dual treatment allows taxpayers to benefit from lower tax rates on gains while also receiving full deductions on losses. However, there is a rule called the non-recaptured Section 1231 losses rule. If a taxpayer has Section 1231 losses from previous years that have not been recaptured, current year Section 1231 gains up to the amount of those prior losses are treated as ordinary income rather than capital gains. This rule prevents taxpayers from deferring ordinary income recognition on gains indefinitely. In summary, Section 1231 assets affect gains and losses by providing favorable tax treatment. Gains are taxed at capital gains rates, while losses are deductible as ordinary losses. This treatment encourages investment in business property by offering tax advantages on asset sales. For accounting purposes, gains and losses on Section 1231 assets are reported on the income statement according to these tax rules, impacting the business's taxable income and tax expense calculations. Understanding these aspects can help you navigate your financial statements more effectively.